Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is Market Today, a show where we share all the latest updates of the stock markets with our viewers. At this point in time, halfway through the markets, we are seeing some downward ticks. Again, for the third day continuing, the Sensex down by 286 points, 60,067, 17,908. The current level for the Nifty, it's down by 84 odd points. So 0.5% cut for the major benchmark indices. Talk about the Nifty Bank, that's down by 0.8%, underperforming the benchmark indices right here. Also, when you talk about the broader markets, the mid and the small caps, they're also down in the red with 0.6% of a cut is what you can see on both the mid cap 100 and the small cap 100 indices at this point. In terms of the other sectors and the movers here, apart from the FMCG sector, rest all of the Nifty sectors are actually trading downwards today, led by losses in the private banks, that's down by 1%, IT is down by 1.4% to another cut of about 1.4% in the media stocks. You do have realty space dragging today, the PSU banks, pharma, well, you name it. Most of these stocks are actually down in the red and the sectors as well. It's just the FMCG majors that are looking at some kind of gains at this point in time. Even the market breadth, when you talk about the Nifty stocks, 33 stocks are actually pointing towards the declines with 17 advances at this point in time. In terms of the gainers, you have SBI Life, M&M, Britannia, ONGC and Reliance Time. In terms of the gainers, you have SBI Life, M&M, Britannia, ONGC and Reliance Industries supporting the markets from to actually stem the fall that we've been seeing. And on the other side, you do have the same names that were declining yesterday. Bajaj Twins, Bajaj Finserv, Bajaj Finance down in the red, 2.4% down as well in trade today. When you also talk about the other majors like TCS, Kotak Mahindra Bank, Coal India, these are the other laggards at this point in time. But time now to welcome our guest for the day. It is the New Year special that we've been continuing from 1st of Jan. And today joining in with me is a veteran of markets, market expert Ajay Bagga joins in. Welcome, sir, and thank you so much for taking out the time to discuss market outlook for 2023. Here's hoping that the year turns out to be very profitable and a healthy one for you, for your loved ones, and also for your team as well. To start off with, I want to understand from you that we've had a choppy start to 2023. What are you really making of that market temperament right now? And is it an opportunity to buy, or would you still wait to see whether the dust settles anytime soon?
Yeah, I would be cautious, Sakshi. I don't think the US market has made the bottom for this cycle yet. And I'm expecting one more downturn sometime in the next couple of months. The Fed is not done yet. The markets are discounting a Fed pivot by the end of the year. But the Fed is going at great lengths to tell the market that we are not going to cut any rates this year, and maybe next year we'll look at it. Right now, we are going to keep raising rates till we meet the inflation target. So in that scenario, it's not looking like a very good quarter, at least for the markets. I would be cautious and conserve capital right now. We will get better opportunities in the second half of the year.
Okay. What, according to you, would be, say, similarities and the differentiating factors of 2023 when you compare it with the last year?
It's very different from last year. 2021, the Fed was forecasting that they would not raise rates till 2023 at least, or maybe for the next couple of years at least. So it was once in a 50-year kind of a rate hike that we saw. Moving from 0 to 4.25. 284 rate hikes were done by central banks globally. So if you had to describe 2022, in short, it was persistent and surprising inflation, rate hikes, central banks getting hawkish, energy shock, commodities running off, and a war in the center of Europe after 75 years. So geopolitical tensions going up. 2023, we are more conservative. I think we are more pessimistic going into 2023. There was much more hope in 22. And I'm hoping that we'll be pleasantly surprised by the time the year comes to an end. Right now, all analysis is baking in the worst. And that normally doesn't happen. When 60 out of 60 economists on Bloomberg or Reuters are saying that there's a US recession and a global recession this year. Normally, it should not happen.
Yes. So how scary could be that fear of recession for the Indian markets per se?
See, we are going to grow. We'll slow down maybe 1%. The issue for us is the nominal growth will come down from, say, 15% to 7 to 9% because inflation will come down quite sharply for us. So real growth of about 5% and maybe inflation of 3 to 4%. Nominally, we'll grow at 9, which is very strongly correlated to the corporate earnings.
Yeah.
Second, the US recession, Sakshi, normally has a pretty inordinate amount of impact on India. We are a domestic economy. 58% of our GDP runs domestically. All that is true. But what happens is when the US goes into this kind of a recession, then you do see that the Indian economy also slows down.
Also, what could be the other downside risks for the Indian equities in 2023? You did talk about the Fed continuing with its rate hike move, taming the inflation right there, recessionary fears you've talked about. What could be the other downside factors that one should be aware of?
See, one is we don't know how the China reopening happens. My personal thesis is positive, optimistic that where we were thinking China would come out by the reopening of China would happen by June, July. Now it's got preponed to March, April. So the COVID peak is probably behind us as far as China is concerned. And post the lunar year holidays, you might see a different set of stimulus coming from China. That will help the global economy. So that's the upside risk. Then you could see stocks moving up quite fast with a full China reopening. But when China reopens, commodity prices go up. Oil could also shoot up, which becomes a negative for India.
Yeah. So do you also see fund flows within the emerging markets moving to China this year as the market has now turned attractive from a valuation perspective? And would this in turn mean that flows to India will slow down?
Yeah, absolutely. See, if you look at 1 year forward China, it was at 8 times in October. So very undervalued, and the market had really not given you returns for nearly 15 years. Now it has moved from 8 times to 12 times. It has outperformed even from mid-October to now because money has been going into China despite all the policy issues. India, on the other hand, is about 18 times 1 year forward. And our average normally is about 17. So marginally more than what we are on average. It's not even one standard deviation more than our average. But on a relative basis, we are very expensive to the rest of the world. The US is at about 17 times 1 year forward. You can compare that. Of course, India is domestic and India is a structural growth story. So we deserve that premium. But in the short term, flows could go more into China. But here also, I would give a optimistic spin to it that the global emerging funds and the Asia ex-Japan funds that invest in China, maybe China will get the 40%, but we will also get the 15%. Last year, we also lost because people were taking money out of China, especially the GEM funds, the global emerging funds. When they pull out of India as well, because it's the whole fund which is getting liquidated by customers. So we should benefit. It should not be as bad a year in terms of FI flows. Also, what we'll benefit from is a peak dollar. So if I'm expecting in the first quarter, we should reach a level of both Fed rates where you factor in a 5% terminal rate and the dollar. And then as the dollar goes down, that's inversely correlated to emerging market flows, inversely correlated to India flows. As the dollar weakens, we see flows getting regenerated, coming back to India and emerging markets. So again, the second quarter or the second half might be much better in terms of flows. The first 5 days in January have not been too good, but that we have seen a very huge selling broad-based across. It's not that only IT is being hurt, but banks which were an outperformer last year are getting sold. So it's the entire Indian market. So that's more a fund liquidation that's happening. It's not active stock pickers who have been selling. for.
Okay. But last year we did see, sir, that DIIs and the retail investors turned shock absorbers. When the record outflow was by FIIs was mitigated by the record inflow by the DIIs in the Indian markets. Do you see that trend continuing? And for the small retail investor, how is the year going to pan out?
Small retail investors should continue their SIPs. That has done very well right from 2020. And that takes 5-6 years to really show you the magic happening, the magic of compound interest. So they should continue, stay invested. There's not much to fear that we are not going back to 2008-9 kind of 60% cuts to the market. Maybe it's a sideways market as far as India is concerned. Domestic institutions, we are expecting $8 billion of EPFO, the Provident Fund money, to continue. That's very retail. Secondly, as far as the mutual fund SIPs, that's another $18 billion. And the insurance would be another $12 to $14 billion. So we are looking at about $40 billion of net inflows into the Indian market on a domestic basis, which gives a lot of strength to the market. IPOs take away some part of this. So we'll have to see how the IPOs take liquidity out. But overall, Indians are still very underinvested. And this is a multi-year structural change which is happening. This 40 billion will go to 50, will go to 100 also. And you will see a point, like last year was a change, Sakshi, where despite FII outflows, we could manage an outperformance, 4%, but still we were in the positive. Normally, in an earlier year with this kind of a thing, we would have seen a huge downfall in the markets.
That's true. Since you talked about most of the downside risks which one needs to be prepared for and yet continue with their SIP strategies, do you think any particular expectations from the earnings this quarter and the upcoming union budget as well, could those provide some kind of a relief from these recessionary fears?
Yes, a union budget should help the rural consumption. A big part of last year's drag was rural consumption getting hit. The migrant economy has not fully recovered. The migrant remittances domestically have not come back to the pre-COVID levels. So the informal sector, the small sector is suffering. The large companies have gone back above their 2019 levels. So rural consumption should get a boost from the budget. The tax inflows are strong. That gives some fiscal space to the government. The big issue that we see coming is the RBI rate hikes will start now impacting the broader economy. So, 9 months, 12 months get over by about April to May for this rate hike cycle. So we are expecting RBI to hike once more and then stop. Ideally, it should stop right now because the inflation is going down. There is no more reason to hike the rate. Already financial conditions are tight, both globally as well as within India. But I think they will be pressurized on the rupee front to hike once more, and then they will stop at 6.5. And around April, May, you could see some impact on the Indian economy. Europe will be in recession, UK in recession, Japan slowing down. The big optimism is US continues to hold its own and doesn't go into a very deep recession, maybe just a soft landing, maybe just a mild recession. Atlanta Fed, Sakshi, for December quarter, they are forecasting nearly 3.9% year-on-year growth in the GDP for US. So from 3.9 to get to a minus print for 2 to 3 quarters, right now it's looking difficult, unforeseeable. But after 2022, we have all become very careful in giving any forecast.
Absolutely. Let's not lose sight of the markets. They're trading at the lowest point of the day now. 60,000 has been breached on the Sensex on the downside. 59,930 is the current level, 422 points down. 17,866 now for the Nifty. 125 points gone there, 0.7% of a decline. If at all of these factors that you've mentioned that could pose as major risks, they were to all come, how much downside from here can one really be prepared for?
See, you can take that around 10% from here. There is very strong support. And then the low that we saw last year, about 15,200. Those would be the disaster levels. But
Yeah.
again, I'm not anticipating that. What is
Okay.
happening right now, again, the global volumes are still low. Next week is when we really see all the funds back in action
Yeah.
in a full flow scenario. Right now, a lot is being factored in on a very hawkish Fed, but
Yeah.
we are losing sight that where we were 0 to 5% kind of a journey, we have reached 4.25 already. It's 0.65 or 0.75 more to go as far as the Fed rate hike goes. Most of the damage has been done. It has flown through, and still the US economy has been quite resilient. Europe has managed the energy shock quite well so far, and a mild winter has helped. You see the natural gas prices, you see the oil prices. So too much of the risk has been factored in, and we could then get an up move in the markets. I'm not
Yeah.
very worried on this. I don't see it going too far. But the worst case scenario would be the 15,000, 15,200 levels on Nifty.
Okay. And if one were to stick to some specific themes or sectors, any sector that you believe could actually turn out to be a dark horse in 2023, be the scenario may as subdued and, cautious as we are just talking about. But some of the themes that could definitely outperform, it could be the time that they are, the front runners.
Yeah, see, like auto has done well, but it's been subdued post the festival peak, and sales have been down. But margin will come back. Margin expansion will happen with lower commodity prices. Cement, we are expecting, which got hit quite badly last year, both on volumes and margins. I think margins will come back, and cement could be a surprise winner. And then a bank and financials. IT, I would say in 6 months' time, we'll get an entry point. So
Okay.
be ready to move into IT. Right now, we are services companies. We are not product companies, but we get impacted by the US macro. So all will depend on how soft the landing is in US, how far the Fed takes this rate hike cycle, and when does the inflation start to come down to a Fed comfort level. That is what will
Absolutely.
determine the IT performance. Unfortunately, it's out of our hands. It is out of the management hand. So you have to just wait out. There is no other option there.
Just last question to you, Mr. Bagga. For the millennial investors who've just entered the markets in 2023, how should a millennial investor really construct their investment portfolio between different asset classes, within the markets, however you want to suggest?
A best asset class for a millennial investor is equities. Be 100% equities. I would throw out any asset allocation for you, apart from buying one house where you live, and take a loan for that, so that it forces your savings and inflation works for you with that real estate. As soon as you can take a loan, take a loan. But you should be 100% in equities, because you have 40, 50 years more of your working lives, and invest in SIPs. So invest regularly, don't bring in lump sums. These markets are going to be very tricky, at least for the first 3 to 6 months. Once we get a US bottom formed on a sustainable basis, then you should be all in. Then that will be the time to bring in any money lying on the sidelines and putting it also in.
All right, understood that. Well, thank you so much, Mr. Bagga, for being with us and sharing all these wonderful insights with all our viewers as to how to approach markets in 2023 and how to create a portfolio that could actually turn out to be a big winner and give them handsome returns going forward into the long term as well. And wish you a very happy new year once again. And thank you so much for speaking to us on Business Today TV. Let's look at how the markets are trading. 450 down for the Sensex, 59,898. Lowest point of the day, 129 points gone for the Nifty, 17,862 at this point in time. But we'll leave it at that. We'll continue to track the market movement and see whether there is any chance of any kind of a bump up or a bounce back from the lowest point of the day towards the closing of the session, because we've been witnessing that trend around 2:33 p.m. We do see some kind of a bounce on the upside. Will we get that today is something that we'll have to watch out for. The last trading session of this week, should it be a Free Kick Friday, or will we actually end the day by saying thank God it's Friday? We'll keep an eye out on that, and for that you should stick with us on Business Today TV. Don't forget to subscribe to this channel and also stay with us and engage with us via our other social media platforms, Facebook, Twitter, LinkedIn and Instagram. Many thanks for tuning in.
A push that can boost privatization of public sector firms. The government has exempted the minimum public shareholding rules for PSU banks and for CPSEs headed for privatization. Currently, companies need to have a minimum public shareholding of 25%. It's now been decided that PSUs being privatized will be exempt from this rule. Let's go across to Karishma Sadani for more on this. Karishma, take us through all the details.
Well, right, Abha, this is definitely going to be a major push for the IDBI bank disinvestment. The center has amended the Securities Contract Regulation Act for strategic disinvestment to exempt listed companies in which the government and public sector undertakings together hold majority stake when it comes to the sale. In fact, this was also much expected. If you remember, just before